All right, so today we're diving deep into intelligent investing.
Ooh, I like that.
And, specifically, we're going to be looking at Benjamin Graham's The Intelligent Investor,
Yes.
which is quite the classic when it comes to investing books, right?
It's the Bible of
Yeah.
value investing.
So we're not just going to kind of like skim the surface here. We're going to really try to unearth like the core principles
Yes.
and the practical wisdom that Graham offers in this book
Yes.
so that you as the listener can kind of take
Oh.
that and use it to navigate the investing world, right?
Right, and I think what really sets Graham apart from other financial thinkers is his emphasis on psychology.
Yeah.
He's not just talking about like PE ratios and balance sheets. He's really diving into
Mind games.
the mind games, exactly. He
Yeah.
understood that the investor's psychology, their own emotions, are often their worst enemy.
So it's like he's saying our brains are literally wired to sabotage our own portfolios.
That's exactly right. And his own life story kind of illustrates this point.
Oh, really?
So early in his career, he had this incredible win.
Right.
He invested in a company called Savold Tire.
Okay.
On its very first trading day, the stock soared, giving him a 250% return.
Whoa, talk about beginner's luck.
Sounds amazing.
I have a feeling there's a twist to this story.
There is a twist.
Yeah.
Just months later, the company was exposed as a fraud.
Oh,
The stock plummeted, becoming practically worthless.
wow.
So it was a harsh lesson for Graham,
Yeah.
but it really shaped his understanding of the market's, sort of this duality, this
Okay.
incredible opportunity,
Yeah.
but also this potential for irrational behavior and folly.
So instead of getting discouraged by that, he kind of used that experience to develop his approach to intelligent investing.
Exactly. He realized that intelligent in this context doesn't necessarily mean like having a genius IQ.
Okay.
It's about cultivating specific character traits. Things like patience, discipline, eagerness to learn, emotional control, and really, really thinking for yourself.
So it's more about mindset than math skills.
Exactly.
Okay, that's reassuring for some of us.
Yeah.
But how does that actually translate into action? Like,
Right.
how do we practically become these quote-unquote intelligent investors?
Well, Graham really makes a clear distinction between investing and speculating.
You okay?
Investing for him is about thoroughly analyzing a company, digging into its fundamentals, understanding its earning power,
Mhm.
its assets, its management, and really trying to determine its intrinsic value, that true worth that might be hidden beneath the surface.
So you're like looking for these hidden gems
Yeah.
that the market is kind of overlooking.
Exactly. You're trying to find those undervalued assets, those diamonds in the rough.
I like it.
Speculation, on the other hand, is more about trying to predict
Mm.
and profit from short-term market swings.
Oh, so that's where the emotional roller coaster comes in.
Ex-
It's that temptation to like chase the quick profits and get caught up in all the hype.
Right. You're trying to time the market rather than really understanding the underlying businesses.
Gotcha.
And Graham, having lived through that Savold Tire experience and then really delving into market history,
Yeah.
he spent a lot of time analyzing market data spanning over a century,
A lot of data.
looking at all these boom and bust cycles.
Oh.
And he came to the conclusion that even seasoned professionals, they really struggle
Yeah.
to consistently time the market.
So even with all the fancy algorithms
Yeah.
and all the technical analysis tools that we have today,
Right.
you're saying that trying to predict those short-term movements is essentially a gamble?
It is. It is very much a gamble. He even points to this thing called the January effect,
Okay.
where, historically, small cap stocks tend to outperform in January.
Interesting.
Sounds like a sure thing, right?
Yeah, yeah.
But even there, he found that the high trading costs
Right.
often wiped out any potential gains.
So it's a cautionary tale against chasing these seemingly predictable patterns.
Yes.
It's like trying to outsmart a casino. The house always wins in the end.
Right.
Right.
Exactly.
So instead of trying to time the market, Graham argues that we should be focusing on building a really robust portfolio
Yes.
that's based on a solid understanding of the businesses we're investing in.
Right.
And he outlines two main approaches to this:
Uh-huh.
the defensive investor and the enterprising investor.
Yes.
So let's break those down a little bit. Like,
Yeah.
what kind of investor personality does each of those approaches kind of cater to?
Okay, so the defensive investor is all about minimizing risk and effort.
Okay.
They're not looking to spend all day, glued to the ticker.
Right. They want a more hands-off approach.
Exactly. They want a solid, steady approach.
Gotcha.
And for them, Graham recommended a balanced portfolio, typically a 50-50 split between stocks and bonds.
Okay, so that sounds simple enough on the surface.
Right.
But even within those categories, like, how do we make intelligent choices?
Right. I'm
Like,
guessing just picking any stock or any bond won't cut it, right?
of course not. Of course not. So let's start with bonds.
Okay.
In Graham's time, he was a big fan of U.S. savings bonds
Right.
because they offered a guaranteed return and, they were backed by the full faith and credit of the U.S. government.
Right. The ultimate in safety, theoretically.
Exactly. But he did acknowledge that their advantages might not always hold true depending on the market conditions.
Yeah, things change.
And the interest rate environment. So he suggested exploring other options as well, like U.S. government bonds, corporate bonds, but with caution,
Okay.
and preferred stocks, always keeping in mind the tax implications of each.
So bonds they're not a one-size-fits-all solution.
No.
We need to consider like interest rates, maturity dates, and the creditworthiness of the issuer.
Absolutely. You got to do your due diligence.
Now, when it comes to stocks, what did Graham recommend?
Well, for the defensive investor, he believed that diversification was key.
Don't put all your eggs in one basket.
Right.
So instead of chasing high-flying growth stock,
Yeah.
he advocated for investing in large, well-established companies with a proven track record of stable earnings and dividend payments.
It's kind of like building a portfolio of steady workhorses rather than betting on these untamed stallions.
Exactly.
Yeah.
But there's this classic investing advice out there that you've probably heard.
Buy what you know.
Buy what you know. Exactly. So what did Graham think about that?
Yeah, does that fit into his philosophy?
He actually challenged that notion quite directly.
Really?
He even used Peter Lynch as an example, who was a famous investor, championed that approach.
Yeah.
While familiarity with a product or service might give you some insights, Graham argued that it shouldn't be the sole basis for an investment decision.
So just because I love a particular brand of coffee doesn't mean I should rush out and buy their stock without doing my homework.
Exactly. You still need to do that thorough analysis of the company's financials, look at their competitive landscape.
All right, so thorough research is crucial.
Absolutely.
Even for the seemingly safe bets.
Yes.
All right, now I'm kind of curious to get into the nitty-gritty of Graham's approach.
Yes.
To actually analyzing a company's financial statements.
Let's do it.
Because I think that's where the real treasure lies.
That's where the rubber meets the road.
So how about we take a little break and then come back and really delve into that?
Sounds good to me.
All right, so we're ready to roll up our sleeves and get into those financial statements.
Let's do it.
I have to admit, this part can feel a little intimidating.
I understand.
Where do we even begin? Like, how do we actually start to make sense of all those numbers and figures?
Well, Graham provides us with this really helpful framework for evaluating a company's intrinsic value, that true worth, that might be hiding beneath the surface of all the market hype.
Right.
And he emphasizes 3 key areas: earnings power, assets, and then the financial structure.
Okay, let's break those down one by one.
Sure.
Earnings power seems pretty straightforward, right?
Yeah.
We're basically looking at how much profit a company is generating.
It's more than just looking at the current profits, though.
Oh, okay.
Graham encourages us to look at the company's earnings over a period of several years to kind of smooth out any of those temporary bumps or dips that might occur in any given year.
So we're not just looking for like a one-hit wonder.
Exactly.
We're looking for consistency.
Yes.
Sustainability in those earnings.
Exactly. You want to see a track record of solid earnings that suggests the company has a durable competitive advantage.
Okay, that makes sense. Now, what about assets?
Assets, yeah.
What kind of assets should we be paying attention to?
Well, Graham was a big fan of tangible assets.
Tangible?
Tangible, so things you can physically touch.
Okay.
Like property, factories, equipment, that sort of thing.
So real estate, machinery, inventory.
Exactly, and readily marketable securities as well.
Okay.
These are assets that can be easily converted to cash if needed.
I see.
He was a little more cautious about intangible assets, like goodwill or brand value.
Oh, okay.
Those can be a little bit harder to value objectively.
So it's kind of like comparing a company with solid real estate holdings to one that has like a brand name that's built mostly on hype.
Yeah, think about it like this.
Yeah.
I want to see assets that are actually underpinning the company's earning power.
Right, not just like abstract notions of what the brand might be worth.
Exactly. You want that solid foundation.
Gotcha. And then finally, you have the financial structure.
Yes.
I'm guessing this is where we assess the company's debt levels.
Exactly.
And their overall financial health.
Absolutely. So a company drowning in debt.
That's a red flag.
That's a big red flag, even if their earnings look fantastic on paper.
Right, because those earnings could be going straight towards paying off interest payments.
Right, and high debt can really limit a company's flexibility, make it more vulnerable to economic downturns.
That makes sense.
And ultimately increase the risk for investors.
Yeah, so we're essentially looking for companies that can weather those storms.
Yes.
And emerge even stronger on the other side.
That's the idea.
But even with all of this analysis, even if we do all of our homework, isn't there still a degree of uncertainty? I mean, the market can be so unpredictable.
Absolutely. And that's where Graham's famous concept of margin of safety comes in.
Okay. Tell me about this margin of safety.
So it's essentially the difference between the price you pay for a stock and its intrinsic value.
Okay.
So by buying at a discount, you're creating a buffer to protect yourself from unforeseen events or errors in your analysis.
I like the sound of that. It's like having this built-in cushion.
Exactly.
For when things inevitably don't go exactly as planned.
It's like a safety net for your investments.
And I imagine the wider that margin of safety, the better.
The wider the better, absolutely.
Okay, so would a company with a really predictable business model and a long track record require a smaller margin of safety?
Potentially.
Than, say, like a tech startup with a brand new product.
Right, because there's more uncertainty with the tech startup.
Right.
You know, their future is less predictable.
Yeah, they could be a flash in the pan.
Exactly. So you want a bigger cushion for those situations.
So it sounds like determining this margin of safety.
Yes.
It's not just about plugging numbers into a formula.
No, it's not a precise science.
It requires some judgment.
It does, right.
Weighing all these factors that we've been discussing and being realistic about the potential risks.
Absolutely. It's about combining that objective analysis with a healthy dose of caution.
It sounds like a blend of art and science.
It is.
You know, bringing in the human element.
Right.
And now I can't help but think back to Mr. Market.
Ah, yes.
That pesky character you mentioned earlier.
He's trying to sway our emotion.
Yeah, so the margin of safety, is that essentially our shield
It is
against his irrationality?
It's our protection against his whims and his swings from euphoria to despair.
So even when Mr. Market is in a frenzy and offering us these seemingly irresistible deals, we need to step back, assess that intrinsic value. Make sure we're buying with that sufficient margin of safety.
Exactly. Don't get caught up in the hype.
Which brings us to another crucial aspect of Graham's teachings. Managing our emotions.
Oh, that's the hard part.
This feels like the most challenging part of the equation.
Right? It is for many people.
How do we stay grounded when the market is on this roller coaster ride?
Well, Graham was very insightful in this area. He drew from the work of psychologists like Kahneman and Tversky, who really understood how our brains are wired to overreact to losses and get caught up in herd mentality.
Oh yeah, we're social creatures.
We follow the crowd. And so Graham stressed the importance of having a clear investment plan and sticking to it no matter how wild the market gets.
It's about having that roadmap to guide us, those predetermined principles that prevent us from making impulsive decisions based on fear or greed.
You got it.
So we've talked about intelligent investing, but let's talk about speculation.
The elephant in the room, right?
Yeah. I mean, even when we know better, there's always that little part of us.
That gambler.
That's drawn to like making a quick buck, you know, outsmarting the market. So did Graham acknowledge that human tendency at all?
Oh, absolutely. In fact, he dedicates a significant portion of The Intelligent Investor to addressing speculation head on.
Interesting.
You know, really dissecting it, revealing its allure, but also its pitfalls.
Okay.
He wasn't naive to the fact that even the most disciplined investors might be tempted by that siren song of quick profits.
So for those of us who might be tempted to dip our toes in those speculative waters, what kind of guidance did he offer?
Well, first and foremost, he reiterated the importance of separating investing from speculating.
Okay.
Remember, investing is about owning a piece of a business,
Right.
participating in its long-term growth. It's based on thorough analysis of a company's fundamentals.
Right.
Speculation, on the other hand, is trying to predict and profit from those short-term market swings.
So it's like the distance between building a house brick by brick and betting on which way the wind will blow.
That's a great analogy.
One's a long-term endeavor.
Yes.
Based on solid foundations.
Exactly.
The other is more of a gamble.
It is a gamble.
And Graham believed that for most people, consistent success in speculation just isn't realistic.
It's not realistic. He argued that it's driven more by luck than skill.
Oh.
And even when someone gets lucky, it can create this dangerous overconfidence.
Oh, I see.
That leads to bigger risks and often bigger losses down the line.
So it's like winning at the casino once and thinking you've cracked the code.
Yeah, you've got it all figured out. When in reality, the odds are stacked against you.
And he also warned against using borrowed money.
Yes. Leverage.
Leverage for speculation.
Very dangerous.
Why is that?
Well, because leverage amplifies both gains and losses.
Oh, okay.
So it makes that downside potential even more significant.
So it's like adding fuel to the fire.
Exactly.
It can make things exciting.
Yeah.
But it can also get out of control very quickly.
It can. It can wipe you out.
So if we're determined to try our hand at speculation, what is the intelligent approach?
Yeah.
Is there a way to do it without being completely reckless?
Well, Graham, ever the pragmatist, did offer some guidelines. He suggested setting aside a small portion of your capital, no more than 10%, specifically designated for speculation.
Okay, so it's like a fun money account.
Yeah, a play money account.
For experimenting, taking some calculated risks, but keeping it separate.
Yes, very much.
From the serious business of building long-term wealth.
Absolutely. That's your foundation.
But even with this fun money, did he have any other rules?
Oh, absolutely. He emphasized the need for discipline, risk management, and a clear exit strategy.
Oh, so don't just get swept up in the excitement.
Ew.
Treat it like a controlled experiment.
Exactly. Have a plan.
He also acknowledged that some people might have a natural aptitude.
Yeah, he called them the gifted speculators.
The gifted speculators.
People with that keen sense of market psychology, the ability to identify those short-term trends.
So he wasn't completely dismissive of speculation.
No, he recognized that for some people, it might actually be a viable path.
Interesting.
But even for those gifted individuals, he still stressed the importance of discipline, risk management, and emotional control.
Yeah, you can't let those early wins cloud your judgment.
Exactly. Don't get cocky.
So for the vast majority of investors, though, Graham's advice was pretty clear.
Stick to intelligent investing.
Right.
Avoid speculation altogether.
Focus on what we can control.
Exactly.
Thorough research, value investing.
Long-term perspective.
Long-term perspective, right?
That's the key.
It's about playing the game where we have the best chance of winning.
Right.
Using our strengths.
Playing to your strengths.
Recognizing our limitations.
Absolutely.
Well, this has been a truly fascinating deep dive.
I've enjoyed it.
You know, we've uncovered those core principles of intelligent investing from understanding that key difference between investing and speculating to analyzing a company's financials and even managing our own psychology.
It's all connected.
It really is.
It's all part of the puzzle.
It's a wealth of knowledge that I think can empower us to navigate this financial world with more confidence and clarity.
I agree. And remember, this is just the tip of the iceberg.
Right.
Graham's The Intelligent Investor is really a treasure trove of wisdom that can guide you throughout your investing journey.
Yeah.
So dive in, explore its depths.
Keep learning.
Keep learning, exactly.
And to our listeners, thank you for joining us on this deep dive.
Yes, thank you.
We hope you've gained some valuable insights to help you on your own path to financial success.
Absolutely.
And remember, as Benjamin Graham so wisely said, the intelligent investor is a realist who sells to optimists and buys from pessimists.
Words to live by.
So stay curious.
Stay disciplined.
And above all,
stay intelligent. Stay intelligent.